If you are not paying attention to taxes on dividends, you are giving your hard-earned dollars to the government for no reason. And in today's video, I'm going to talk about one of the most important aspects of investing, and that is tax, specifically taxes on dividends. And frankly speaking, it's one that a lot of people either don't think about, they get wrong, or they miss out on totally, and it can cost you thousands of dollars. Why give up thousands of dollars if you don't have to? That's the point of today's video. First, the basics. Dividends are essentially payments from corporations to shareholders, usually on a regular basis. Could be monthly, could be quarterly, could be annually. And this is done to share profits as a way of rewarding their shareholders for their loyalty. So essentially, dividends are your share of the profit made by these corporations. And the beauty of those dividends is that they can provide you with a steady stream of income indefinitely as long as that corporation continues to make profit day in and day out. And if you want, you can reinvest those dividends into even more shares and have potential for even more capital gains. But did you know that dividends are taxed differently than compared to other forms of income in Canada? In fact, dividends can actually save you on taxes. That's right. Making money from dividends can also increase your income and also save you on taxes. It's honestly a beautiful thing, and I want to explain that in this video. So how do dividends actually save you money on taxes? Well, it's all thanks to the dividend tax credit that we have in Canada. And it's super important that if you are a dividend investor, you learn how to take advantage of this dividend tax credit. This is a special tax break that reduces the amount of taxes you have to pay on your dividend income compared to other forms of income if you make the same amount. For example, you'll pay less on dividends than compared to rental property income, compared to interest income, or even compared to employment income. And all this may sound too good to be true because you can increase your income and lower your taxes. Well, how does all that work? Well, like I said, it's all thanks to a dividend tax credit. But there's a catch. Not all dividends are eligible for the dividend tax credit. That's why it's important you watch this whole video, because I'm going to explain how all this works. Only dividends paid by a Canadian corporation held outside a registered account. So when I say registered, think of your RRSP, RRIF, TFSA. Only those dividends paid by Canadian corporations outside of these accounts are eligible for the dividend tax credit. Dividends paid by foreign corporations, now it doesn't matter if that foreign corporation is a US-based, German-based, Japanese-based, they don't get the same tax treatment as Canadian corporations. And if you're earning dividends inside your RRSP, well, once you withdraw those dividends from your RRSP, you will get taxed at the same rate as if you had made that income from interest or employment, and that is also at a higher tax rate. So how does the dividend tax credit work in Canada? And most importantly, how can you save on taxes? It's all a little bit complicated, but I'm going to do my best to explain it in simple terms and give you some examples so you really walk away after you watch this video with a good understanding on how you can take advantage of this dividend tax credit. First, the dividend tax credit is actually composed of two parts. It has a federal component and it has a provincial component. The federal component is a fixed percentage of your dividend income, while the provincial dividend tax credit varies depending on which province you live in Canada. Now, in order to calculate your dividend tax credit, first, you have to gross up your dividend income by a certain factor. This is because dividends are paid out of a company's after-tax profits. So the gross up is meant to reflect the pre-tax amount of income that the company has earned. The gross up factor is currently 38% for eligible dividends and 15% for non-eligible dividends or ineligible dividends. Eligible dividends are essentially dividends paid by large Canadian public corporations, while ineligible or non-eligible dividends are paid by small private Canadian corporations or foreign corporations. The reason eligible dividends are taxed so favorably is because of this dividend tax credit, which is essentially the foundation when it comes to the concept of tax integration in Canada. And let's run through some examples to really illustrate this concept. As an example, let's say you earn $100 of business income and you are in a 30% tax bracket. That means you pay 30% tax and $30 of taxes. Very simple. Now let's assume you decide to incorporate that very same business and you still earn $100 of business income. And now the corporation has a 12% tax rate. So the corporation is now paying $12 of tax. With the remaining $88 because of after-tax business that your corporation has, you're going to distribute a dividend to you, the shareholder. Now, when that happens, the dividend is grossed up back to the original $100 that the corporation earned. You then pay a 30% tax on that dividend, but that dividend is grossed up, and you receive a dividend tax credit of $12. So net, you're only paying $18 in tax. Now, if you're keeping score here, in the first scenario, the CRA received $30 of tax from you, the business. In the second scenario, the CRA has received the very same $30. It's just that the corporation paid $12 and you paid net $18 after the dividend tax credit. So net, the CRA and the money in your pocket, it's all the same. Now, the math doesn't work out so perfectly, but it's very close most of the time. And that very same concept we just talked about also applies to public companies with a bit of a difference, in that they pay an eligible dividend, meaning they are eligible for an enhanced dividend tax credit because these companies pay a tax rate that is typically closer to 25 to 27%, again, depending on the province that they do business out of, not the 12% in the original example. And so the whole reason why dividends are taxed so favorably is because the corporation has paid part of their tax for you. And in doing so, their value is reduced by the taxes paid. The dividend tax credit essentially allows you to pay personal tax rate on what was otherwise taxed at corporate tax rates. And I've said tax way too many times in the sentence, but there's a second example coming. And any negative dividend taxes is essentially a refund of taxes overpaid within the corporation. And any positive dividend taxes represent the additional tax that is payable had the source income been earned personally. Again, here's a second example to really break this down. So let's say you have earned an eligible dividend of $4.79. And if we gross that up by that gross up rate we just talked about, which is 38%, your taxable income in this case is $6.61. And let's assume your marginal tax rate is roughly around 35%. So that means if we take your $6.61 of taxable income, multiply that by your 35% tax rate, you have a tax liability of $2.31. Now here's where that dividend tax credit kicks in. So you're going to receive a 15% tax credit on the $6.61. That gives you a 99-cent tax credit. So that means the net you really have to pay in taxes is your $2.31 we just talked about, minus the 99 cents tax credit. So that means your net tax is only $1.32. So that means had you had invested $100, your pre-tax yield would have been 4.79%, and now your after-tax yield is 3.47%. Now, to really bring this concept home, I want to show you real-world examples of what it means to earn dividend income versus other forms of income and how the taxes are integrated, and basically how much tax you may have to pay based on the different source of income. So let's check out the Wealthsimple calculator for this example. So let's go ahead and try out some examples using the 2023 Ontario Income Tax Calculator. Let's say you earn $50,000 of employment income. That means the total tax you're going to pay on $50,000 of salary income is just under $10,500. Now, what if you had earned that same $50,000 but as self-employment income? That means your total tax is now over $12,000 because of the increased CPP premium that comes as a part of being self-employed. Now, what if instead of $50,000 in self-employed, you had capital gains of $50,000? Well, look at that. You're paying less than $2,500 of taxes. And let's say instead of $50,000 of capital gains, you made $50,000 of either interest income or rental income. For tax purposes, they're pretty much treated the same. So in this case, had you earned $50,000 of interest income or rental income, you're paying just under $8,000 of taxes. Still much more than capital gains, but far less than employment income. Now, what if, here's the fun part, what if it was all eligible dividends, $50,000? Well, look at that. You're paying only $600 of tax. That's a tax rate of around 1%. So that means if you make $50,000 in self-employment income, you're paying $12,000 in taxes. But if you're making $50,000 eligible dividends, it's only $600 worth of taxes. Now, what if, let's say, instead of eligible dividends, you made $50,000 of ineligible dividends? Well, even in that scenario, you're paying less than $3,000 of tax on $50,000 of income. You can clearly see that you've pretty much won the tax game by making $50,000 in eligible dividends by paying only $600 of tax, compared to someone who's working really hard, day in, day out, going to their job, maybe working some overtime, and they're making $50,000, and they're going to pay roughly between $10,000 to $12,000 in taxes. Meanwhile, on the other hand, the investor who's making $50,000 from dividends is paying tax at either $3,000 or $600 based on eligible or ineligible dividends for doing far less work. So what this shows you is that the tax system is essentially favoring investors versus those who are going out there and trading their time for dollars. Let me summarize this on a spreadsheet to show you what I mean. So as you can see, I have assumed you're making $50,000 of income from rental, eligible dividends, ineligible, salary, capital gains, self-employed, and interest income. And here's the different taxes you're going to pay on each of that income. And I've done the same example at $100,000 of income to really hammer home this point. So take a look at what I mean. The three lowest forms of taxes on the same income at $50,000 is dividends, whether eligible or ineligible, and capital gains. And on salary and self-employment, you're paying close to 21 to 24% taxes on those hard-earned dollars where you are trading your time for money. Now, what if instead of $50,000, you're making $100,000? If we look at that scenario, when it comes to eligible dividends, you're paying less than $5,000 of taxes. Now, here's the real interesting part. You've made $100,000 in eligible dividends, and you're paying $5,000 in taxes. In this example, you've made half the income, but you're paying double the taxes. You made $50,000 in income, and you're paying over $10,000 in taxes. So you can clearly see how our tax system is favored towards investors. Eligible dividends, ineligible dividends, and capital gains, you're paying roughly between 5 to 15% tax rate on those sources of income. Whereas if you're earning rental income, salary, self-employment, or even interest income, you're paying over 20% up to 28% in taxes. And you can see this visually. Eligible dividends are the far lowest and the most tax-effective forms of making income. Meaning, yes, it's important of how much money you make, which will determine how much tax you have to pay, but it's also equally important how you make your money, whether it's from dividends or whether it's from your hard-earned time exchanged for dollars. Thank you so much for watching this video. Hopefully, I was able to shed some light on why dividends are taxed so favorably and how that same type of income, whether you earn it from salary, self-employment, rental, interest, or dividends, it's taxed differently. If you can please do me a huge favor, if you found this video helpful at all, hit that like, subscribe, and thanks button. And do me another favor, please share this video with others so you can also show them the concept of how powerful it is to earning investment income versus trading your time for dollars. Make sure to check out the links in the description below for some great discounts on services that I use on a daily basis, and I want you to at least check them out. Maybe you'll find something you like. That's it for now, and I'll talk to you in the comment section.